Now, I'm going to range far and wide, as I usually do. The fact it's difficult is not going to stop me from saying some provocative things and making some big, bold calls. This is what I'm going to talk about. I'm going to start by saying something about the world scene. I won't say much about it. Most of what I've got to talk about is about the UK. And then I'll say something about COVID, putting it into context and hopefully bringing some understanding. I'll tackle the question of the structural changes to business because of COVID and also because of something else that's coming along. The fiscal crisis, are we heading for doom and gloom there, taxes due to go up, spending to be squeezed and so on. Then I'll come to inflation and interest rates. I'll say a word, not a lot, you're the experts, but I'll say a word about what we think about commercial property prospects. And finally, I'll say something about what I think the next 5 years holds in store. So, the world scene, that's where I'm going to begin. We're used, of course, over recent years to thinking that China is set inevitably on a path to become the world's largest economy, and possibly pretty soon. And there's been an awful lot of truth in what people have said about that. But China is now facing a very strong adverse headwind. That's to say, demographics. The Chinese working population is now falling. It's going to fall a good deal further. This is a result of the one-child policy of some years ago. Though it's been rescinded, the effects are now coming through. Big problems for China. The growth rates will still be high by Western standards, but those very high growth rates, it's sometimes in double figures, they're not coming back. China set to slow. Now, the US, despite its various difficulties, by contrast, does not face a headwind of that sort, and I'm relatively optimistic that it will grow fairly well. You know me, I'm a Eurosceptic. The day I stand here or somewhere like this and say the Eurozone's booming, fill your boots, you know that there's a problem. Well, it isn't, and I'm not. It's likely, I think, to be rather disappointing in its growth rate. There's also some, I think, rather concerning political uncertainty. Tony referred to this earlier on in his opening remarks. There is actually a fair bit of uncertainty, believe it or not, although we all thought the Merkel era was over when the Germans had their recent general election. Of course, she's still there. We still don't know who the next chancellor is going to be. It could be months. My only suspicion is that a new German government, when it's formed, will not actually initiate a really radical change from past policies, if only because the new government is likely to be a coalition of some widely different parties, probably the so-called Rainbow Coalition, and that may be the right thing to do, but the result, I think, is unlikely to be a radical departure. The one political event that I think doesn't fit into that category, or possibly, is the French election. It is highly uncertain. We don't even know who the candidates are going to be. Macron hasn't declared yet. I think there's more than an outside chance that this chap called Eric Zemmour, who's come from nowhere, is a journalist and broadcaster, and he's up in the polls, there's more than a reasonable chance that he could win. Now, if he does win, then that really could set the cat among the pigeons. He's strongly Eurosceptic. He's described as being from the right, but he doesn't carry the Le Pen name, which is a big advantage. There's a real possibility, I think, that we could see an upset in France. Then in the States, remarkably, we could even see the return of President Trump. He's looking a lot more vigorous than Joe Biden, who has to be kept away from the screens and the microphones, hidden away in case he makes some ghastly gaffe. Return of Trump, careful what you wish for. Yes, so there's a few snippets about the world scene. I wanted, though, before I leave the world, say something about globalization, because this has definite business implications. A lot of people have been saying that COVID's going to put an end to globalization. I think that's completely wrong, but it has introduced some changes, or rather it's consolidated some changes that were underway anyway. I think globalization had just about peaked on a number of different measures before COVID came along. But the result of what's happened, and of course at the moment we're all suffering from supply shortages, the result of what's happened is to make security of supply much more important in business and state decision-making than it was when price seemed to be overwhelmingly important. intense rivalry between the US and China. Now, you may think that's stating the obvious, but not that many years ago, it wasn't obvious. Of course, it was Trump who started this, but it isn't just a Trumpism. As we have seen, this anxiety about China continuing under President Biden. Now, the reason for mentioning this here is I think this is going to have major impact on business and business practice. Essentially, what's happening is America is setting about separating itself and its zone of influence and control around the world from China. It will still trade with China, but it just is so wary of China's tentacles that it's setting up essentially a separate system. So rather than thinking the world is coming together, I think we're entering a period where it's dividing into two separate zones, American and Chinese, and countries will have to decide which countries and companies, which zone they're in. Now, there was a time when people thought it was possible to ride both horses. This is what David Cameron and Osborne thought when they were cycling up to China, becoming really very comfy and cozy with China, while still trying to keep America on side. It's quite clear now that that is not possible. America won't allow it, even if we thought it was a good thing to do. And by and large, I think now we don't think it's a good thing to do. So that's the world briefly in a nutshell. I now want to turn to look at COVID, or rather the economic impact of COVID. And I'm going to start with a couple of charts. I guess you're going to be familiar with the overall picture, but I think it's worth ramming home. This is what happened to GDP in a range of countries in 2020. China is the country on the left, which remarkably managed to register an increase in GDP, despite, of course, COVID beginning there. And just about every other significant country saw GDP fall by quite a lot. The country on the far right in brown is dear old Blighty, us. We had one of the most devastating effects of COVID of any country in the world, not quite the worst, but pretty much the worst in this gathering of countries, which are largely G7 and one or two extras, the Eurozone as a whole. So brown was our colour there. Now let me show you what I think is going to happen this year. Again, it's China on the left in the lead, registering a pretty significant increase in GDP of almost 10%. Then the other countries really follow the previous pattern in reverse, which I suppose is not so surprising if you think about it. You know, the countries that saw their GDP drop significantly are the ones that are more likely to experience a big increase. And the UK does well on that basis, you see, ahead of other European countries and ahead of America and so on. But that's just the short-term impact. Thinking about how this is going to leave us more generally, I think we have to come to terms with what COVID has done to the economy. And I'm going to talk about business structure in a moment. But first of all, let me make it absolutely clear that this is a very, very unusual depression indeed. And we economists have had to put our thinking caps on. You know, ordinarily, we get depressions caused by some sort of monetary or macroeconomic phenomenon, a rise of inflation or interest rates or something rather. Occasionally we get a financial crisis of the sort we had more than a decade ago. Of course, there are non-economic events like wars, which have a big impact. But this sort of thing, we haven't seen anything like it, well, for more than 100 years. Very unusual. No destruction of physical capital, no loss of workers, and no loss of financial capital and purchasing power. In fact, if anything, the opposite. Walter showed you in his slides earlier on, massive increases in the money supply and savings deposits, strong, by and large, strong asset markets recently. So this ghastly phenomenon, which caused GDP to plummet in so many countries, has not had the usual impact that such ghastly events do have. One of these things, sometimes all three, often happening. So given all that, what should we expect the continuing effect of COVID to be? Can we ever get over it? Now, I'm going to show you a few charts now, which are conceptual in nature, because I think people often get confused when they try to answer this question, will we ever get over it? Now, this chart here shows the path of output that an economy would have been on had COVID not happened. That's the top line. And then below, the putative path of output that this imaginary country has followed. And I've drawn a horizontal dotted line from A to B, and A is the point at which these two things diverged. A is the point at which COVID began to send output down, and B is the point at which that level of output is regained. Now look, in this case, which I'm calling scenario A, in one sense, we never get over COVID. In the very narrow sense of do we ever reach B, that's to say, do we get back to the position that we were in before the pandemic struck, then yes, we do. And plenty of countries are almost there. Indeed, we're almost there. I'll come to that in a moment. But look at the right-hand side of the chart. Even after we've got back to where we were before COVID began, we're not back at the same path. And that gap on the far right, that purple bit, the gap between the line showing where the economy would have been and the blue line showing where the economy is, that gap economists typically refer to as scarring. And this is fundamentally important because if that's what the future is, we never get back to the previous path, then we will never be as prosperous as we would have been without COVID. And there'll be all sorts of long-term consequences, including for the public finances. And debating how large that gap is a key bit of controversy at the moment. But things aren't bound to be, as this chart shows them to be. A more optimistic scenario, which I'll call B, is that there's no scarring. Here you see the blue line at the bottom comes back and joins the line at the top. So eventually, we get back to the same path of output that we would have been on without COVID. That's more optimistic than the previous scenario. But note something, even if that happens, even if we get back to point C, there would still have been a dead weight loss from COVID, which we will never recover. And that is the shaded purple area. It's gone, the lost output, the lost consumption. We'll never recover it in this scenario. Now, it's actually possible to be more optimistic than that. That's to say, there are a few people who believe this. Scenario C, after output gets back to the path it would have been on anyway, it actually carries on above the path that it would have been on anyway. And in this example I've given you here, the blue shaded area is supposed to be equal to the purple shaded area. In other words, there's a period in the future when that dead weight loss from COVID is made up by more output than we would have had without COVID. That is a pretty optimistic scenario, but there's something even more optimistic than that. That's to say, where that blue shaded area ends up being bigger than the dead weight loss from COVID. Now, how could this possibly be? What does it amount to? Well, it amounts to the idea that, believe it or not, in the end, the pandemic was a good thing. How? Is that possible? Well, it is just about possible. And the argument would be that it unleashed efficiency savings, which would not have been unleashed, or at least not on that scale, without the pandemic experience, including working from home, a whole load of things. Well, which of these scenarios is the more likely? It has to be said that official forecasts, certainly in this country and I think also in other countries, have been too pessimistic. Our Office for Budget Responsibility, the OBR, is usually a bit pessimistic, and it has been very pessimistic. It's been saying that the degree of scarring, remember I explained that at the beginning, the gap between the two lines, the degree of scarring amounts to about 3% of GDP. The economy will always be 3% smaller than it would have been without COVID. At Capital Economics, we think that's too pessimistic. We're somewhat closer to scenario B, that's to say where the bottom line gets up to the top line, there's hardly any scarring at all. And that's true. Well, there's some, not because we don't think there will be any scarring, but rather there will be some scarring, but it'll be offset by some efficiency gains. And the result will be that the economy gets back more or less to the path that it was on anyway. And that is extremely good news. Less confident again about the recovery in the Eurozone. Some people in the US, of course, Americans being naturally very optimistic people, believe that scenario C is possible. Remember, that's the one where you get this big blue area, shaded area above the line. So you actually have a period in the future when output is higher than it would have been without COVID, and that outweighs the dead weight loss during COVID, but virtually no one believes the super optimistic scenario D. Where are we in the UK at the moment? Well, here we are. We're very nearly, but not quite back to the pre-COVID level of output. In a quarter or two, we will be back there. So in that sense, we will have recovered. We will, one suspects, never offset or recover that dead weight loss. In this chart, we don't quite get back to the top line, but if we extended it further on our forecasts, we pretty much almost would. So we think the degree of scarring, long-term scarring, will be very minimal. Now, that being said, let's move on to say something about the structural changes brought about by COVID. Now, of course, no one knows the answer to these questions, but I've got a decided view. There's going to be less bricks and mortar retail activity, more online. That's pretty clear. I'm optimistic that once we're allowed to go everywhere, leisure travel will pretty much resume on the path it was on anyway, but I don't think that's true of business travel. I was chatting to Tony before we started. I don't think it's true of business travel. This is an example where something was possible anyway without COVID, but it took COVID to jolt people into a realization they could do things differently. That's to say, have meetings remotely, not necessarily always, but rather than going to 4 meetings, board meetings, let's say, in person, they might do 1 in person and the other 3 might be done remotely. This, I think, is going to go on a big scale, and the result is going to be much less business travel. Working from home, I've got to put that up, but I have to say, I think since this whole phenomenon began, the climate has changed. Although there is still continued large amounts of working from home, especially in the public sector, well, certainly at home anyway. I think very much that the tone has changed because it's become clear that although there are some efficiency savings from being at home, also there are some big losses. It's quite clear that particularly if you're trying to train people, they need to be in the office. And it goes above and beyond training. It's also about inculcating the spirit of the organization, the culture, learning by doing, young people in a sort of apprenticeship way, not being formally taught, just picking up almost by osmosis the way others in the office are doing things. You can't easily do that remotely. Then, of course, there's the whole business of the fellowship, the comradeship, in the best offices anyway, from actually being with your pals. And we noticed it in our organisation, that in particular, the youngsters who are living in fairly cramped accommodation somewhere in central London can't wait to get back to the office. Indeed, they are now mostly back to the office, but the older ones living in some leafy paradise somewhere in Hampshire aren't quite so keen. Now, associated with this, there's the potential for big changes in the desired location for living. But as I said, I think some of this is going on, but I suspect it's been largely overdone. And insofar as it is true that there's going to be still a significant amount of working from home, of course, the implication is reduced demand for commercial property. Now, that's had a number of people getting quite pessimistic. I think wrongly so. Again, they've overdone things. The death of the office has been much exaggerated, in my view. So has the death of the city, because even if it's the case that there's less commercial demand for offices, there's still going to be an awful lot going on in cities, and there's a major opportunity in the property sector. That's to say, refashioning the space that's available for other uses, in particular residential. This is going to be big, and not just residential, but also leisure. People are still going to want to congregate together, and big cities like London and others have got tremendous advantages. So I think there's big redevelopment potential. It's going to be needed, and it's going to happen, even if there will be a bit of a reduction in the normal demand for offices. Now I'm going to switch gear a bit before I get on to stuff to do with debt and taxes, to talk about a subject that's related to this. That's to say, what I think is the coming before too long of a 4-day week. Now, you may think that's a bit fantastical, but in 1931, the great economist John Maynard Keynes, one of my heroes, published a very striking essay called Economic Possibilities for Our Grandchildren, 1931. And in that essay, he made some very striking claims. He said that over the next 100 years, in countries like Britain and America, the standard of living would increase so much, it would go up in total by between 4 and 8 times. Think about the time he was writing. This is after the Wall Street crash, the Great Depression underway. It was a remarkable thing to be saying. And what's more, people would react to this by working less. He forecast that the working week would drop to 15 hours. Now, how has Keynes's predictions stood up? The 100 years is not quite up. He's got another 10 years to go. But actually, the first part has stood up remarkably, brilliantly well. He said between 4 and 8 times. The reality for Britain and America, depending on how you measure things, is somewhere between 5.5 and 7. So he was right about that. 15-hour week? You must be joking. He was completely and utterly wrong about that. As we know, people typically work between 30 and 40 hours. However, he wasn't wrong about the principle, and I'm going to show you some charts which indicate just how much working hours have fallen over the years. This has major implications for the work-life balance, for how companies organize their employment, and also, of course, for the leisure industries, because there's the question, if people work fewer hours, what do they do with their time? Well, this is what's happened to the average amount of working hours in the UK, going back, would you believe it, to 1760. It's been on a long-term declining trend. A lot of people seem to think, by the way, that there's something God-given about the 5-day working week. There isn't. If there's any length of the working week that's God-given, it's 6 days, because you remember from your Bible that God created the world and then he rested on the 7th, giving rise to the Sabbath. And until comparatively recently in the West, people still used to work on Saturdays. And actually, I remember a 5.5-day week in a number of different areas where people would work on Saturday mornings. This is not just a British phenomenon, this decline in working hours. This is true for the G7 as a whole. I haven't got data going back quite as far, but it's the same pattern. And now I want to show you a chart which, when I came across this data, just sent me into paroxysms of ecstasy. And that will tell you just what strange creatures we economists are and what stunted lives we lead. Here we are, average annual hours worked in the UK going back to 1260. That's the sort of stuff that really gets me going. When I show these long-term historical charts, there's usually some smart aleck in the audience who says, very interesting, Mr. Bootle. Can you tell me, is this data annual or quarterly? And my response is it's daily, seasonally adjusted. Now, why am I showing you this chart? Well, for a start, it makes it perfectly clear that over hundreds of years, the amount of working time has varied quite a lot. You see the peak at the time of the Industrial Revolution. But what I really want to draw your attention to is the bit on the left where you see that sharp drop. Anyone, any idea what all that's about? Why should there have been a sharp drop in the annual working hours in the UK? What is it, 13 something? I think around about 1370. Well, the reason is, it's a cheerful topic this, it's the Black Death, which wiped out about 1/3 of the population. And in those days, in complete contrast to COVID, the working population, but it struck people pretty much indiscriminately. It wiped out about 1/3 of the working population. And so the result, as all the economists in the audience will know, was bound to be an increase in real wages. And how did medieval man, and it was then, sadly for the women in the audience, almost entirely men doing this sort of work, how did medieval man react? He reacted by saying, okay, I can get the same amount of money and therefore consumption as I used to be able to get by working fewer hours. That's what I'm going to do. And they did. So the notion that there's some fixed amount of time that people should work is just baloney, I'm afraid. And I confidently believe that over the next several years, it doesn't happen next week or next month, but over the next several years, we're going to see a further decline in working hours with major implications for all your businesses. Now, let me come on to the more conventional stuff about debt, tax, inflation, and interest rates. Another bit of long history, I'm afraid, this time only going back to 1700. Public debt in the UK is a percentage of GDP. Should we be worried about all this debt, often referred to as the debt crisis? Now, this is the most difficult thing in economics to grasp this, because the answer is yes and no. the most difficult thing to maintain balance when looking at a thing like this. There are certain worrying consequences from having a very high debt ratio, but it is not necessarily catastrophic, which is why I'm showing you the chart. Now, what the chart brings out is the two previous peaks. The one on the left is the time that Britain was fighting Napoleon, which took the debt ratio to the then unprecedented level of about 200%. And then you've got another peak, or two peaks actually towards the right. The first one is the First World War, and then the absolute peak, one that shoots up, is the Second World War, which took the debt ratio to 250% of GDP. Now, by comparison with these things, the current upsurge is a tiddler. We've been through this before, and in neither case did it bring disaster. The period in the 19th century when we were working down the debt then from 200% was the period of Britain's ascendancy. The period in the 1950s and 60s when we were working down the debt from the Second World War was the fastest rate of sustained economic growth this country's ever had. These were the years that Macmillan, the Prime Minister, told us, you've never had it so good. So the notion that because we've got this debt, we're bound to be stuck with very low rates of growth for a long time is, I'm afraid, just baloney. What matters is what we do about it. Can we live with it? And can we adopt economic policies that allow us still to grow? That's the key. And the last thing we should do, I would contend, is aim to get that debt ratio down suddenly by big rises in taxation. That would be a big mistake. Now, I draw a distinction between the debt and the deficit. The deficit is the flow, the debt is the stock. We can't allow this stock to keep going up and up and up willy-nilly. So we should be trying to bring the deficit down to zero, which puts a lid on the stock. But even then, I would argue we should be very wary of doing it by increased taxes. That's the way debt ends up causing problems for economies, if chancellors of the exchequer ramp up tax rates as a result, and that damages efficiency and incentives. Now, of course, you could cope with this by slashing capital spending. That's what governments have done in Britain over many years, and it's not a good idea, with the exception of some daft projects. I won't say more. We're going to have to contain current spending to get on top of this, but I would argue absolutely do not put up taxes. Allow economic growth to bring down the debt ratio gradually. Now, inflation, another historical chart, but not going back so long, 1950. We all know about the inflation scare that's going on at the moment, although this morning's figure at 3.1 was actually better than the market was expecting. What's going to happen? Let's put it into context. The chart neatly, clearly shows you the twin peaks of inflation in the 70s and early 80s, driven partly by big rises in international oil prices. These were the days also of militant trade unions. Many of us in the audience, I'm sure, remember those times. We've not seen anything like that since. The recent spike is worrying, but I don't think we're going to get back to anything like those levels. What's driving inflation? Well, a mixture of things. A series of supply side shortages and rises in energy prices. Now we're beginning to see upward pressure on wages. This has been made a bit worse by Brexit, but you know, all this is exaggerated. People complaining that Brexit has caused the empty supermarket shelves, the HGV driver crisis and everything else, also caused the weather to deteriorate, apparently. I mean, really, they ought to take a look at the international news. The ports of California clogged up, super tankers and container ships stretched all across the horizon. They can't unload. Why? Because they can't get HGV drivers. Now, okay, I might have said I thought Brexit was a momentous event, but I don't think it can explain that in California. So a whole series of factors like that. But then over and above that, you've got, and Walter referred to this earlier on, a massive monetary expansion. And this one, unlike what happened in the financial crisis, has landed up in people's bank accounts. So you've got the backdrop here of the potential for a substantial amount of demand. And in those circumstances, the combination of particular prices going up, minimum wage, net zero, all these cost factors, and the demand, the combination of that will push inflation higher. How high will it go? Well, of course, no one knows, but I'll give you a view. My concern is that central banks have been too complacent. Of course, both these central banks and people in the markets and most of us have not seen anything like this for getting on for a generation. They've come to think that inflation really is dead. There's another death that was exaggerated. It was a pretty good call when I published the book in 1996. But I mean, it was poetic license. I mean, I never thought it was dead as such. I thought it would play dead for the next quarter century, and indeed it has. But it's always had the capacity to come back to life. I think central banks have been too complacent. A lot of them have been saying, look, what's driving the cost level up, the price level up? There are temporary factors. Well, you know, in every inflation upsurge I've studied or lived through, this is always the case. People say, oh, it's only that sort of price. It'll soon subside. Or it's only some other sort of price. It'll go down. And it virtually never does. What happens is the price and cost increases get spread from sector to sector and they become embedded. And when they're embedded, then you're up to a higher rate of inflation. And that's the danger, I think, now. I think we'll see inflation at something like 4.5% by the end of this year and maybe a peak of 5% next year. What happens, whether that gets embedded or whether the rate comes down, depends a lot, I think, on policy. And that's what I'm going to talk about, particularly interest rate policy. The crisis level of 0.1% seems to me, it's bonkers in the current circumstances. I mean, you can argue whether it was the right policy to adopt at the time. I think it probably was. It's an all-time low by a considerable margin. Before that, the all-time low was 2%. It's virtually zero, giving money away, as the Bank of England is. Anyway, I think this no longer makes any sense. And it's causing all sorts of distortions in the economy, not least in the housing market. When you have interest rates that low, you can't expect the economy to function normally. So I actually think, although there will be people who will be damaged by a rate rise, in many ways, in terms of efficiency, the economy will work more efficiently, and certainly the financial markets will, once we get interest rates a bit higher. We need to get back to something like normal. Now, normal isn't double digits. I mean, those nightmare days aren't coming again. I don't know, 4 or 5% maybe is normal, but even that won't be attained for quite a few years. I think the first rise is coming soon, despite the better inflation news. If I were on the MPC, I'd be voting for a rate rise in November. And I thought what Governor Bailey said the other day seemed to me to be a very clear warning of an early rate rise. So I expect one soon, November, maybe December, and then rates to carry on edging up next year. And I think we may well see 2% bank rate at some point next year. This is big stuff, of course, if it happens. Commercial property, I'm not going to say a lot about it, but how does it stack up in this sort of environment? Well, obviously there's a negative factor coming at it from interest rates and bond yields, because if I'm right about what I've said on interest rates, then gilt yields are going to be moving up pretty much across the yield curve, all maturities. And it isn't just going to be about bank rate, it's also going to be about inflation fears, which will be affecting the long end. All that, of course, is not positive for the commercial property sector. Similarly, the points I've been making about a hybrid working environment and the gradual move to a 4-day week, all of that is not good for the demand for commercial property. But I'm going to show you in a moment some things which might put your mind at rest a bit about it. But I've stressed that it seems to me in this environment there are major opportunities for redevelopment. And though you may not have picked it up, I am actually very optimistic about economic strength in this country, and a strong economic revival will support rents. Value, always important when looking at commercial property, and that's what we do at Capital Economics. We track the margins between yields on property and yields on bonds and yields on equities, and ask the question, does property look expensive or not? Well, if you track property as against gilt yields, which is the upper line there, the dark one, then property doesn't look expensive at all. As you go down the chart here, property is more expensive against the two asset classes. Against bond yields, it doesn't look expensive at all. But that, of course, is not, well, it is consoling, but it's actually also misleading, because the bond market is surely overbought on any long-term view. And as rates go up, QE subsides, inflation worries pick up, then bond yields are going to rise. I'd pay more attention myself to the yield against equities, the lower line, and that shows a more balanced picture. It doesn't make property look cheap, by the way, but it doesn't make it look notably expensive by past standards. So I think this is a strength. The property market does not begin this difficult testing period as rates go up from a position of overvaluation. In my view, it looks roughly okay. And for what it's worth, this is how we see total property returns in a range of European countries over the next few years. Again, I've put the UK in brown, as in the earlier charts. It's not, these aren't stonking annual returns that we're seeing, but it's not bad. And we reckon within the European market as a whole, the UK is probably around about third. So I said I would end by saying something about the 5-year view. Well, how will this country look in 5 years' time? Well, one good and positive thing, I think, is that the Brexit wars will be over. They're just about over now. And various people have said, you know, where's the benefit of Brexit? And I must admit, I can't point to many obvious signs at the moment. But what we must remind ourselves of is we've only just left the EU earlier on this year. Although we voted to leave in 2016, we've been arguing among ourselves about whether we should rejoin, what sort of setup we should have for the last several years. But with it, by the end of this period, 5 years' time, all that will be for the birds. And by and large, I think we will be beginning to reap the advantages. Now, our Prime Minister, Boris Johnson, will he be here in 5 years' time? Well, I don't know, but I'm tempted to say I hope not. There have been some really good things about Boris Johnson. In particular, from my point of view, he's got Brexit done and he's seen off Corbyn and Corbynism. Those are two very big achievements. But in other respects, I don't like what I've termed here Johnsonism, or other people have called cakeism. That's to say, a very lax attitude to spending and the control of spending and just splurging in a way that ultimately is going to lead to inflation and higher taxes, higher interest rates, or all three. A senior Conservative recently said to me that Boris Johnson bears a remarkable resemblance to a cushion. What they meant was that he bears the imprint of the latest person he's come into contact with. He is, I don't know, he hasn't got what in politics is called bottom. He's not really deeply secured in the economic realities. And at some point or other, there's going to have to be a return, I think, and it will happen. I don't think much of Johnsonism will survive Johnson. And the result will be, I suspect, a return to a more traditional form of conservatism, placing emphasis on the control of spending and bringing taxes down. Put it this way, if that doesn't happen, then we'll just end up with two socialist parties in this country, one a rather higher spending and tax party perhaps than the other one. I believe that won't happen. This is a phase. We will revert back to a period where the Conservatives will aim to control spending and to bring taxes down. But in any case, related to that, I showed you the long-term historical charts with regard to the debt ratio. In 5 years' time, I think what we're likely to see is that 5 years of economic growth have made an impact on that debt ratio. It'll still be high, but the idea that we're heading for the buffers, I think that will be over. It will be understood that we're in one of those periods where we're just bringing the debt ratio down gradually. And the AI revolution, I think within 5 years, will be starting to have a real impact in raising productivity. And by that stage, people seriously will be talking about the 4-day week, working week. And of course, the corollary of that, the 3-day weekend is coming. Although since it's only Wednesday, not quite yet. Thank you very much.